It's life, liberty, and the pursuit of self-reliance. An Economy of One with Gary Rathbun.
This is our country.
Good evening and welcome again to An Economy of One. I am your host, Gary Rathbun. I'm going to get right into it. Joining me now is Gregory Ip. He's the chief economics commentator of the Wall Street Journal, focusing on U.S. and global economic developments and policy in the weekly Capital Account column and on Real-Time Economics, the Wall Street Journal's economics blog. He's been everywhere, CNBC, BBC, CNN, NBC, the whole alphabet. And he wrote a book a while back called The Little Book of Economics, How the Economy Works in the Real World. And most recently, Foolproof, Why Safety Can Be Dangerous and How Danger Makes Us Safe. Greg, welcome to An Economy of One.
Gary, thanks for having me.
I really appreciate you taking the time with us. I got to start. Going to start with the easy one. Okay.
Sure.
How can danger make us safe?
Well, it's kind of like logical, right? I mean, if you know the notion of complacency is when you let your guard down, bad things happen to you. Well,
right.
If you have a little bit of fear, you're more likely to take care. There's a line from Shakespeare where one character says to another in Hamlet not let your guard down, and to let sort of like best safety lies in fear. Give you an example. I mean, one of the reasons flying is so safe is people are so afraid of plane crashes. Mm-hmm. So the regulators in the industry work really hard to make it super safe.
Yeah, and that makes sense. You know, it was fascinating reading through your book because so much of it was not necessarily about financial and economics. I mean, you talk about the environment, you talk about cars and that kind of stuff, and it stuck in my head. Of course, your story, your discussion about anti-lock brakes.
Right. So I think that's kind of interesting because back in the 70s, there was an active debate going on about whether the federal government should be passing rules to make cars safer. Mm-hmm. And the initial focus was on mandatory seatbelt laws. Mm-hmm. And some economists thought that they had found evidence that when people had seatbelts, they drove faster and they killed more pedestrians. And that triggered a lot of research and debate. And it turns out that while seatbelts do not reduce accidents as much as we originally thought they would, they do still reduce accidents. But when the researchers looked at anti-lock brakes, they found they did not reduce accidents. And it seems that having anti-lock brakes caused people to drive differently. For example, they would hit the brakes harder. So instead of front-end collisions, they would have rear-end collisions. So always with these kinds of innovations designed to make us safe, you have to keep in mind, does it change your behavior in a way that offsets the benefits?
Now that, you could take that, as I was reading that, I'm thinking of a kind of a smart aleck question. Does that mean eliminating brakes altogether would really make us safe? Or?
No.
There's got to be a point of diminishing returns there.
No, you can't drive the car if you don't have brakes. No, I mean, in fact, this is not a story about why we should not do anything to make us safe. It's to try and be reasonable about it and actually study the assumptions, especially in a world which becomes increasingly complex. There are all these reactions and unexpected reactions when you try to make things safer. And the financial crisis is really an example of that, Gary. I mean, people forget that back in the early 1980s, the economy looked like a pretty treacherous place. We had double-digit inflation. We had the Latin American debt crisis. We had banks on the verge of failure everywhere. Right. And Paul Volcker, who was the Fed chairman, fixed a lot of those problems. He got inflation down. He bailed out a bunch of the banks, and then he forced them to hold more capital so that they wouldn't be hurt so much when loans went bad. But at the same time, that actually made banking a little less profitable. So some of that risk actually went elsewhere, went into the capital markets. It went into these lightly regulated finance companies. And these, lo and behold, 25 years later, were kind of the nexus of how the mortgage crisis began. So that's just a long way of saying that whenever you think you're eliminating risk in one place, you got to be careful because it might be popping up in another.
Well, and as I was reading through this, one of the things that stuck in my mind, too, was because I've used this description a lot of time in the old days, way long time ago, in the banks, people evaluated the banks as to where to put their money. And then FDIC came along, or FDIC insurance, and nobody looks at bank balance sheets. Nobody looks at their financial stability or anything before they put their money in there. Is that an example of that safety that we've gotten used to, that we just don't care about the risk anymore?
Although I will say that's a feature, not a bug, in the sense that this came in the 1930s when people would basically yank their money out of banks even at the first hint of trouble, even healthy banks. So the idea behind federal deposit insurance is, yes, it does exactly that. It dulls your incentive to find out whether your bank is actually doing anything silly with your money. But the compromise is we regulate them really closely. We have a lot of people inspecting these banks, hopefully making sure they don't make any mistakes.
Mm-hmm.
Where I think the real problem comes in is when people actually start to associate that same degree of safety around companies that are not being regulated. Fannie Mae and Freddie Mac, for example, these companies that issued a lot of mortgages, and people thought that they were guaranteed by the government, but they were not. But they, in fact, were not part of the government. That allowed them to borrow too much. In the last 10 or 15 years, you had money market mutual funds become very popular ways for people to store their money if they wanted a higher interest rate than the bank gave them. These are not government guaranteed, even though people seem to treat them like bank deposits. And so during the crisis, one of them actually lost money because it had exposure to Lehman Brothers, and that touched off a panic as people pulled all their money out of all their money market mutual funds.
Yeah, I remember that. That's where we learned the phrase "break the buck."
That's right. Yeah, yeah.
And we're still dealing with a lot of that today. People's memories are long on that, and still concerned. We're talking with Gregory Ip, chief economics commentator at the Wall Street Journal and author of Foolproof: Why Safety Can Be Dangerous and How Danger Makes Us Safe. I want you to touch on, because I was not familiar with this till I read your book, and that's the Peltzman effect. Is that how you pronounce it?
Peltzman effect, yes.
Peltzman effect?
Yes. Right. So he's an economist at the University of Chicago. He was the one that did this early research on automobiles and safety belts. And now the Peltzman effect is a term you just hear used a lot of the time when people research these questions. And I'll give you an interesting example, and that comes from football. As you know, there's a concussion crisis going on in professional football. Mm-hmm. And what you learn from the history of football is that this has always been a violent game. Players were actually being killed a century ago, and Theodore Roosevelt read the coaches the Riot Act. In the 40s, until the 40s, the players used to wear like leather helmets, mostly to protect their ears. And in the 40s, they started wearing hard helmets. And the coaches learned that they could actually teach the players to use their heads as battering rams, basically, to bring down opposing players. It was more effective than using their arms. And so they started spearing the opponents. But what this happened was it actually started causing more broken necks and quadriplegias because of the pressure this put on the spinal column. So essentially, by enabling the players to feel safer, it can cause them to use their heads in a way that turned out not to be safe. Now, both the NCAA and the NFL have prohibited spearing, but it still happens all the time that you have players doing these head-to-head hits, partly because the helmets are just so light and strong, and the priority is, if you're a football player, is to bring down the opposing player.
Yeah, it's, and once again, in reading that, I'm thinking, okay, do we go without helmets now? Do we go back to leather? Because, part of that is no matter what the rules are, people are going to do a certain amount of it anyway.
Well, you raise an interesting question there, and in fact, some people have argued that helmets should be removed from football, but I don't know of anybody who seriously thinks that's actually the right way to go forward. They say instead of getting concussions, you'll get skull fractures or something like that. Yeah. People look at the game of rugby, for example. They don't wear helmets in rugby. They're actually not allowed to hit with their heads and so on. I think the key here is not to have a hard and fast rule for or against intervening, is to be smart about it, to actually study the question and find out what actually works and what doesn't. Let me give you another quick example from the world of helmets. We know, for example, from the research that motorcycle helmets really do save lives. They don't cause motorcyclists to ride more recklessly and end up in more accidents. But it turns out that that's not true with bicycle helmets, because if you require people to wear bicycle helmets, a lot of them actually will not ride their bike because they find it's annoying. They didn't bring their helmet with them. Maybe they can't afford a helmet. Okay. They don't like what it does to their hairdo. Yeah. So as a result, they don't get the cardiovascular benefits of riding their bikes. And with fewer bikes on the road, drivers become less aware of the presence of cyclists. They drive faster, and that actually endangers cyclists who are there. So in other words, look, I wear a helmet. My kids wear helmets. But you got to think twice before you pass a rule that says everybody has to wear a helmet, because it might have these unintended effects. Yeah.
Well, you say in your book, and I wrote this quote down just to reiterate it back, was whether a safety enhancement generates offsetting behavior depends a lot on what the enhancement enables us to do. And that's exactly what you're talking about. Is we're gonna choose an alternative behavior or alter our behavior based on the rules, I think. And,
yeah. I mean, and also a lot of these technologies and innovations, they come along and they make people think they can do more than they can do. Back in the 60s when safety bindings on skis first came along, people started to ski more aggressively, and doctors near ski resorts noticed that there were more leg injuries coming in from people who had hurt themselves. And in the financial world, you hear about financial derivatives all the time, these complex instruments that enable the banks to hedge themselves. And once they hedge themselves, they take bigger risks, because that's exactly the point of these instruments. The problem is if everybody does that, you basically raise the aggregate level of risk in the entire financial system.
Now, you mentioned in your book that moral hazards are not necessarily a bad thing. Now, explain that to us.
Okay, and I think it's a pretty key question. So what do we mean by moral hazard? By moral hazard, it's an old term from insurance, and it basically means protecting people from the consequences of taking risks. So if a person gets life insurance, or if somebody gets like car insurance, they might drive faster. And in the financial world, it's like if you actually bail out a bank, does that mean other banks are going to take more risks because they expect to be bailed out? And one of the points that I want to make is that this is a risk every time you introduce some kind of protection or some kind of safety net. And it's not necessarily a bad thing, because sometimes encouraging people to take more risk is actually a good thing. So, just to use a very simple example from automobiles, I actually think if people have snow tires, you can drive in the snow more. You might drive faster and periodically have another accident, but it's kind of a good thing to be able to drive in those conditions. And in the financial world, I'm not crazy about the fact that periodically these bankers go crazy and have to be bailed out, and that gives us a crisis. But if you actually compare countries that have these freewheeling financial systems and countries that have repressed financial systems, for example, if you compare Thailand, which is freewheeling, to India, which is more repressed, the countries that have the more freewheeling financial systems tend to have more crises, but they also tend to grow faster over time, because risk-taking is kind of what entrepreneurialism and capitalism is about. A lot of businesses fail, but a lot of them are going to succeed, and they'll do really well. We want to encourage that. One of the points I like to say is we should not aim for an economy with no crises, because that would basically mean an economy with no risks and no growth.
Right. It's a terrific book, Foolproof, Why Safety Can Be Dangerous and How Danger Makes Us Safe. We can get it anywhere. I got mine from Amazon, but I assume you're at Barnes & Noble and all the major bookstores. Greg, I got about 2 more hours worth of content I'd like to talk to you about, but I know your time's very short tonight.
Sure, but call me back anytime. I've enjoyed talking with you.
I appreciate that. I hope we can tap you on the shoulder again soon. So, Gregory Epp, Foolproof, thanks so much for taking time out of your evening with us today.
All right, Gary. Thanks for having me on the show.
Thank you. Be well. I'm Gary Rathbun. This is an Economy of One.